tax residency is your number one priority whenever it comes down to personal income taxes and corporate taxes. Because based on the tax residency of an individual or a company, that's where you have to pay your income or corporate tax. So one of the most common things I hear is like, well, I don't spend 183 days in Italy, so I don't pay taxes there. Well, that's just a little bit too superficial, because first, you need to understand what does the Italian tax code say about your tax residency. So first, you are a tax resident if you are registered at the local town hall for more than 183 days, or you have for the majority of the tax year your place of habitual abode or center of life interest in Italy. So you might think that the majority of the tax year means 183 days. Well, technically, practically, there might be conflicts between other countries' tax residency, and then you end up having the majority of your tax year spent in Italy, even if you do not match 183 days. So let's say that you spend 100 days in France, 100 days in Germany, 165 in Italy. Well, that's still the majority of the tax year without hitting the magic number of 183. And to add complexity to the matter, remember there are also split year rules. So you know that the tax calendar is not the same throughout jurisdictions. So Italy doesn't have the same tax year as the UK or as Brazil. So how do you define that? So imagine that you spent until June 30th in Brazil, but then you come to Italy for less than 183 days, you didn't spend the most part of the year in Italy. Well, you might have, considering that that tax year is covered by Brazil, and then you have the part in Italy, which is the majority of that. So where do you end up paying taxes? And that's very complicated. That's what you should plan. And you must also look at the double tax treaty, because the question is, if you are challenged as a resident of more than one country, where do you pay tax? To both countries, to just one of the two, or to neither countries? Well, the answer is that you always have an ultimate place of residency. There's always a country which is the place you need to disclose your worldwide income because you're tax resident of that. And if there's a double tax treaty in place, you need to read the clause, the tiebreaker rules, which in case of residency claimed by more than one countries or the two that undertook the double tax treaty, then there are ways to define that. So first, do you have a permanent home available? So if you have a permanent home in country A but not in country B, that's where you're deemed tax resident. Or where is your place of habitual abode? Or where is your center of vital interest? Or finally, are you a citizen of both countries or just one? So whenever there's a tiebreaker rules and one wins on the other, that's where you are deemed tax resident. And this has major consequences, because if you're tax resident of one country, you need to disclose the worldwide income, disclose foreign held asset, and possibly pay wealth tax. So it's very hard actually to define that. And if you think that challenging that at court is easy, you are totally wrong. And finally, just to add a little bit of complexity to the recipe, there is an EU directive that basically rules facts or situation in which you have economic interest in one country and personal interest in one other. So think about that you work in a country and your family lives in the other one. So that EU directive says that the place of effective tax residency is the country in which your personal interests are located. So personal interests beat economic interest. But, and that's the clause, as long as you revert back regularly. So if your family is based in Italy and you work in France and you never come back, well, then your tax residency is France. But if you come back whenever you can, so every week, every 2 weeks, you spend holidays home, well, in that case, your tax residency is based in Italy with everything that it does entail. So my advice is very simple, and I think that very few people pay attention on that, and they just change tax residency how they prefer, and they think they are tax resident of one country or another based on the number of days they've spent in that jurisdiction. This is totally wrong, and you need to get your tax residency straight, because that defines if you pay taxes to that country or not.